My name is Will Martin, and I'm going to be presenting Merck and Company Incorporated, case 12-6. I've included in the email their financial statements, their income statement, balance sheet, statement of equity, cash flow statement. Also, there's a schedule of unrealized gains and losses on their available for sale securities. That's actually a slide in the PowerPoint that I'm going to talk about, and I put the PowerPoint in the email as well, so you can kind of look at it and look at the slide that I'm talking about as I'm talking about it to make it make sense a little bit more. Just an overview of the company. Starting off on slide 2, Merck and Company Incorporated is a global healthcare company. They deliver healthcare solutions to their various medicines, vaccines, biological therapies, and consumer and animal products. Human health pharmaceuticals and vaccine products, which are sold by prescription to treat human disorders, comprise the majority of the company's products in which they sell to wholesalers, retailers, hospitals, government agencies, and managed healthcare providers. They also have operations in animal health that discover and manufacture animal vaccines distributed to veterinarians and distributors. Also, they sell over-the-counter foot care and sun care products, which are sold through wholesale and retail drugs in the U.S. and Canada. And they don't just sell in the U.S. and Canada. They're a global company. They have manufacturing facilities in all over the world. Actually, just opened one in China in April of this year, 2013. Even though the financial statements are for 2009. So, slide 3. The merger with Schering-Plough Corporation. On November 3rd, 2009, Schering-Plough Corporation acquired all of Merck & Company's outstanding shares. Merck & Company Incorporated was renamed to Merck Sharp and Dohme Corporation. So they are now a fully owned subsidiary of Schering-Plough Corporation, which then they changed their name to Merck & Company Incorporated. Schering-Plough was a surviving public company and then changed their name. So it's kind of confusing, but on slide 4, I try to break it down from each perspective. Merck & Company Incorporated, the original company, was acquired by Schering-Plough, renamed to Merck Sharp and Dohme, and they are now a fully owned subsidiary. And it was the old Merck & Company Incorporated. Schering-Plough acquired the original Merck & Company Incorporated and then renamed to Merck Incorporated and Merck & Company Incorporated, and they now own the original Merck & Company Incorporated. So it's kind of confusing, but pretty much Schering-Plough acquired Merck & Company and changed to the same name. As far as with the shareholders' perspective, the original Merck & Company, their shareholders received 1 share of common stock for every share of stock that they held. The Schering-Plough shareholders received 0.576 of a share of common stock in the new company, as well as $10.50 in cash for each share of Schering-Plough common stock that they owned. Slide number 6, the accounting considerations of the merger. From an accounting perspective, Merck was considered the acquiring company in the acquisition. The financial statements shown in Merck & Company's 10-K reflect the company's standalone operations. So pretty much, the financial statements include all the operations just of the original Merck & Company until November. The merger happened in November 2009, so that's when they included the Schering-Plough Corporation's operations are only included on the not the income statement, all the financial statements. They're only included for November and December. They're post-merger operations. So now slide 7, the investments. We're going to get into some of the numbers here. If you look on the balance sheet, it'll show short-term investments in 2009 total $293 million. As current and as non-current assets, $423 million of investments. Merck's debt and equity investments are classified as available for sale securities and reported at fair value. And we'll go into that a little bit more later. But as the composition of their investments on slide 8, the company's investment portfolio includes cash equivalents and short-term investments, the market values of which are not significantly affected by changes in interest rates, which you would expect them being short-term. They're not going to be affected by interest rates as much. The market value of the company's medium to long-term fixed rate investments are modestly affected by changes in U.S. interest rates, but those interest rates have a more significant impact on the market value of the company's fixed rate debt, which generally has longer term maturities. All right, the unrealized gains and losses. Changes in fair value that are considered temporary are reported net of tax in accumulated other comprehensive income. The cumulative effects of the changes in fair value during the reporting period are shown in the statement of equity under other comprehensive income net of tax. So I have the unrealized gains and losses on the available for sale securities. It breaks it out by the investment type and first lists their fair value. So if you look at the U.S. government agency securities, they have $215.6 million is the fair value. The amortized cost $250.7. The gross gains for the year is $1.1 million, whereas the gross losses for the year is $1.2. You net those together to get the change. So there's going to be a 0.1 loss, and that's where you get the difference. You have to net the gain and loss columns together, and it does this for each investment type. So as we go on to the realized gains and losses, whereas the unrealized hit the statement of equity, the realized gains and losses are going to hit the income statement. And here on slide 11, I included a partial income statement. If you look on, I put other income expenses net is bold and underlined. This is where the realized gains and losses are on the income statement. There's $10 billion. And it's a negative. Their revenues, their miscellaneous revenues are in parentheses. Their income statement, they do it a little different. Their sales are at the top of the income statement, and they list their miscellaneous revenue in with the expenses. So you have your expenses, and then your revenue is going to be in parentheses. Then they kind of net their income before tax and everything below it. So the parentheses on this slide are revenues, but their realized gains and losses are reported there under other income expense net. Also, impairment on investments. For declines in fair value of equity securities that are considered other than temporary, an impairment loss is recorded to that other income expense net account. And whenever a company is deciding whether to impair an investment, they consider the potential impairments on an investment and the duration and extent to which the fair value is going to be less than cost and remain less than cost. For debt and equity securities, they look at the company's ability and intent to hold the investment. For debt, if the company has the ability and the intent to hold the debt, they're not gonna record an impairment, because with debt, you're gonna get the principal back once the debt matures. So that's not gonna cause an impairment. Whereas with equity, you could have the ability and the intent to hold the investment, but if the fair value doesn't recover, which with equity, the stock market, you never know if it's going to recover. So there's going to be further analysis done with equity versus than with debt. With debt, you just have to have the ability and intent to avoid having to impair your investment, where with equity, there's going to be further analysis. But once all that's done and it's decided that an impairment loss should be recorded, they're going to debit that expense to this other income expense net. They're going to debit that expense and credit the investment that they decide should have been impaired. Slide 13, investments reported by the equity method. Most of the investments held by Merck are reported by the consolidation method, as they hold a controlling interest in those companies. All other investments are reported by the equity method. Controlling interest is determined by a majority ownership of the subsidiary, which typically is 50%. in the absence of a significant third-party influence or participating rights. Investment revenue from these investments accumulates on the income statement under net income attributable to non-controllable interest. Kind of get into that on slide 14. The bold and underlined account, net income attributable to non-controlling interest, shows $122.9 million of net income. And this is Merck's percentage share of the investee's net income. Because with it being the equity method, anytime the investee reports net income, whatever percentage share we have in that company, we own that percentage of the net income. So it being the equity method, we're going to report that percentage share of their net income as investment revenue, and that's where it's shown on the income statement. That $122.9 million. Slide 15, the cash flow effects. This is just the partial cash flow statement. This is the investing section. The investing section on the cash flow statement shows the cash effects of the investment transactions. And as you can see, the bold, it doesn't say, but if you look at the full statement of cash flows, it'll break everything out. But on the slide, it doesn't show the year, but that first column, the bold column, was 2009. If you kind of net those together, it's about a $15 billion outflow. As I said earlier, they were preparing for the merger, so they sold a lot of their investments to get cash to acquire the company. So they sold a lot of their assets. You can also tell by looking at the balance sheet. And in 2009, their investments were $432 million. In 2008, there were $6 billion. Also, as their short-term investments went from $293 million in 2009 to $1 billion in 2008. So a significant difference in 2008 and 2009, as they were selling their assets to get ready for the merger, is also reflected here on the cash flow statement. And the last slide, slide 16, is just the URL to Merck's 10K, which is about 150 pages long, but the main part is the financial statements and the accompanying notes to the financial statements. So that's all that last slide 16 is, just the URL to get there. And so that is my presentation on Case 12.6, Merck and Company Incorporated. Thanks.